So today I wanted to just give a bit of a response video to the video that I did yesterday, and I feel like it was quite well received, but I feel like there was a few little things that were missed slightly, and I don't know if that's because on the video I sounded maybe a little bit too negative, even though I am a bit worried where we are at the time frame. I don't know if I talked about the points as good as what I could do, and the reasons why I'm kind of feeling this direction, that I am a little bit more worried about where the market is at. And the reason why I'm worried in the market is because of one reason. It's because of interest rates, and the reason being the Fed. The thing that scares me is the Fed and Jerome Powell. I am very worried what they're going to do to the economy. The economy has held up so far and it's done very well, but there's a point where those interest rates keep going up and keep going up, that it's going to affect the economy at some point. If you keep putting up at the rate that they are going up as well, it's going to eventually snap the economy, and that is what I'm worried about as an investor. Now, the reason why, let's take a step back. The reason why I'm worried is inflation, okay? So inflation was an issue. Inflation was an issue because a lot of governments caused the inflation issue, and then the governments were very slow to react to it. And now they are being very slow to stop the interest rates when it isn't needed. So if you look at inflation at the moment, inflation in my opinion is in a pretty good place. Sure, it could come down a little bit more slightly, but from where we were 12 months ago, we're still acting like inflation is at 10+%. Interest rates are still going up rapidly. They're getting increased at big amounts at high paces, which will eventually snap the economy. When it'll happen, that's the big debate. But if you keep doing this, there's only so long the economy can hold up. And we started to see that in companies' earnings in this quarter and the job situation. And when you look at the inflation has pretty much been resolved. Don't get me wrong, it could come down a little bit more, but it's in a very good place from where it was 12 months ago. And interest rates don't need to be double what inflation is right now. You look at inflation, month over month, I think we're up 0.2%. That over 12 months, quick maths for you there, is 2.4%. That's like the Fed's so-called target of 2.4%, which is no major issue. If you look at what is causing inflation still to be high, it's shelter. Shelter is up, I believe in the last report, 7%. Now, if you take shelter out of it, I think on inflation data, we're down at 0.8%, which is way below the 2% target. And I think on the core basis, it's 1.4%, which is once again below the inflation target. So there's one thing that's propping up this inflation report at the moment, which is shelter. Why is shelter so high? Because it's a lagging indicator. It's the last thing to go up, or the last thing to come down. It's a lagging indicator. And what we're starting to see now is that lagging indicator shelter has started to rapidly start coming down. So within the next few months, we will see inflation at the target rate of 2%. But until that happens, it looks a little high. Now the problem is the Fed are not realizing this and are being slow to react to this. And that's what they've always done. And the inflation issue will be resolved. It already has pretty much been resolved apart from the lagging indicators. But what the Fed aren't doing is they aren't reacting to that. Well, they are, but they're reacting to it the wrong way. They're still thinking overall this inflation picture is very grim, when it's not. And what they're doing at the moment is they're putting interest rates up higher and higher and higher when they don't need to be. In my opinion, interest rates should have been paused 3 months ago and they're still going up. Listening to the Jackson Hole meeting that happened the other day, yesterday, the indication was, and like I said, I don't know if the Fed are just saying this and playing the hard game, but I thought they were doing that 3 months ago and they still put up interest rates. And they seem to keep putting up these interest rates, and the indication is they're going to put interest rates up, and they still think inflation is high. They said yesterday that they thought the data was finally good in June and July. And it's like, the data's been good for the last 12 months. Like, you look at the data, it's been coming down and coming down, coming down. Like, what are you talking about? You know? So listening to them, they seem very keen to be putting up those interest rates more and more and more, which is crazy. The job is pretty much done, and they're making it sound like they're still in the middle of the battle of putting these interest rates up. And that makes me nervous, because eventually, if you keep putting those interest rates up, it is going to cause problems in the economy. And that is why I'm nervous. And what that will lead to is a recession. If we have a recession, you'll see companies' earnings dive, revenue dive, job will be in a bad, tricky situation. And then what the Fed will be doing once again is they'll be doing catch-up, going, oh, so what we're going to do now is start cutting rates. Problem is, it's too late. Companies' earnings have been hit, companies' revenue has been hit, and you'll get companies at cheaper prices. And I want to make sure that if that does happen, I can buy them companies. Now, the thing is that, and this goes to the next 2 points I wanted to make here, is I want cash to buy those opportunities. Because if we do hit a recession, I need to have cash to buy. I had the cash in 2021, and basically in 2022, I was just piling the money into it. I held no cash pile. I was buying. Right now, I'm still buying quite heavy. But the problem is that the opportunities right now aren't what they were 12 months ago. In 2022, I was buying like crazy. You had stocks at crazy, you had Google. Google was down, buying that one. I'm up 20-something% on that one right now. DraftKings, I was down 50+% on that one, 60+%. I'm up on DraftKings now. HIMS, I was down 30-40% on HIMS. I was up over 100% on that one. There's so many stocks that I was down on that I was buying, and now I'm up on. And that's because valuations went ridiculously low, but we've seen a bit of a rally now. If we do hit a recession, a lot of those stocks will go back down to those valuations, and I will need cash to buy them opportunities. So I need to not stop my buying. I never want to stop buying in the stock market because, like I said, I could be wrong. The Fed might surprise us. They might be playing the hard game and they'll come out and say, actually, we're not hiking up interest rates. And if that happens, then I'll be stuffed if I've not been, if I sold all my stocks to try to time the market, I'll miss out. If I've not been buying, I'll miss out. So I still need to be buying in case that does happen. But what I also need is that if this is starting to look more and more likely, which I think it is because inflation is down, but the Fed is still hiking up interest rates, that for me is increasing, and I need to be aware of that, and I need to start having cash in case that situation happens, and that's, even like a 10% cash pile. Now, dollar cost averaging, and I think this is probably the mistake that I made yesterday, and I didn't go enough detail onto this point, is people said, but don't you still want to be buying? There's still cheap stocks out there, and I agree. There's still cheap stocks out there. There's not as many as there were in 2022. You got to remember, you had Meta at $80 in 2022. You had Google at $80, $90 in 2022. You had DraftKings at $10. You had HIMS at $3. There was opportunities everywhere. It was like a kid in a candy store in 2022. Now, some of those stocks have rallied up. I've not bought DraftKings for the last 5-6 months. I've not bought like Google for the last 5-6 months. I've stopped buying some stocks, but I'm not going to stop buying completely because there's still opportunities out there. You've still got small caps at the lowest valuations they've ever been. You've still got mid caps at the lowest valuations you've ever been. You've got maybe not Google at historic valuations of low levels, but you've got PayPal at low levels. You've got National Express at low levels. There's still opportunities out there. There's just not as many. So I will still continue to buy the opportunities where I go, I still think that's a good valuation, but I'm not a kid in a candy store anymore. And I'm also a little bit more worried. Back in 2022, I was looking at all the valuations and I was going, there's so many attractive valuations out there. Now, I'm seeing half the attractive valuations and a little bit more risk element to it. But I'm still going to buy some stocks if they're at attractive valuations, because at the end of the day, if we do avoid this, if this doesn't go up, the Fed surprises, I still want to have a portfolio that goes up. I still want to be buying opportunities that are looking good valuations. But I also need to be careful and have a cash in case this situation starts building up, which is caused by the interest rates, which is caused by the Fed increase them interest rates way too much. That doesn't need to be increased on inflation. And that's the big situation I'm trying to get to you. The mindset I'm at the moment is where I've gone in 2022, where I was buying everything in sight as much as I could because they were ridiculously cheap, into 2023 where, okay, there's still opportunities out there, but not as many. And also, I'm a little bit worried about this and I need to have a cash pile just in case that situation happens. So it just slows down the buying. I'm still buying, but slowing down the buying, building up a cash position in case this happens. And that's the key thing that I'm doing now. There's that slight little pivot in that strategy. And that's what I wanted to kind of give a little bit more information on. Because I think yesterday's video might have sounded that I went a bit too much to the other direction. and I've gone like that. I've not gone like that. I've gone a little bit to that side where I'm just being a little bit more cautious now because there's a few things that I've seen that are worrying and a couple less opportunities. Still opportunities out there, but not as many opportunities, not 2022 opportunities. And that's the big thing I wanted to kind of get across there. So hopefully with that little information there, like I said, I think a few people were worried like I've suddenly gone like ultra bearish. Don't get me wrong, I'm not as bullish, but I'm not Michael Burry. There's not that situation. And I think people thought that was it. I'm going to stop buying. I'm going to be reducing my buys because some of that will be going into a cash pile, but I'll still be buying, but just not as much. So an example would be so far next week, I've probably got one buy lined up that I'm going to do. Whereas normally, as you guys on the page would know, I'm probably nibbling 3-4 stocks. Whereas next week, I'm kind of thinking about only buying one stock. And that's like the kind of difference there. So I hope you enjoyed it anyway. If you do want to see more content from me, join the Patreon. I posted an exclusive video last night that explained the reason why I have just sold one of my stocks. And with that money, I'd go buy a new stock. So if you do want to see that information, join the Patreon. I also post 2 exclusive videos a week on there. There's actually 3 exclusive videos last week. And there's going to be 3 this week as well. And it's only £5 a month. It's probably why it's the highest Patreon to YouTube subscriber out there on the YouTube scene for the stock market. So if you do want to join, that link's in the description. Thanks for watching, guys. I hope the little extra information there was a little bit useful. Have a great weekend. See you in a bit.